Inflation. In the world we live in right now, it is a big concern for everyone. People seeing their savings lose value, investors struggling to stay above inflation rates, businesses thriving to survive, and politicians claiming to have the magic solution. Inflation has been a big concern for all of us for the last 2 years. So, what should we do? In this video, we will review 5 different investment categories and how Warren Buffett would classify them in periods of inflation. The worst thing to do in times of inflation, according to Warren Buffett and other great investors like Ray Dalio, is to hold cash. This is because during times of inflation, the cash you have sitting in a savings account or in your bedroom at home is worth less and less with each passing day, week, month, and year. One of the most important points I want you to take away from this video is that you, as an investor, need to think of your investment returns in real terms, which is basically accounting for inflation as well to get a real value of the purchasing power of your assets. Let's say, for instance, that you earn 12% in 1 year. If inflation that year is 7%, in reality your return is 5%. In fourth place we have bonds. These investments are generally considered very safe by conventional investment wisdom, but Buffett would argue that these investments are not really that safe when you factor in the impact of inflation. Let me explain what I mean. The current yield on a 10-year U.S. government bond is about 3.5% at the time of making this video, compared to a potential 4% inflation over these years, which is not unreasonable considering current inflation is over 7%. Would mean that if you bought a 10-year government bond today, you would get a negative annual return every year for a decade after factoring in the impact of inflation on your return. This is still better than simply holding cash, but still far from the best alternative. Next in this hierarchy is what Buffett refers to as non-productive assets. These are things like gold, silver, and other precious metals. These are not terrible to own during a period of inflation, because all other things being equal, as the price of everything else increases, these things in theory should at least keep up with inflation. However, these unproductive assets are also not likely to increase your purchasing power. Here is a video in which Warren Buffett talks about gold.
Is gold. And I've used this illustration before, but if you take all of the gold in the world, don't get too excited now, and put it into a cube, it will be a cube that's about 67 feet on a side. That'd be 165,000 or 170,000 metric tons. So you could have a cube, if you owned all the gold in the world, you could have a cube that would be 67 or 68 feet on a side. And you could get a ladder and you could climb up on top of it and you could say, I'm sitting on top of the world, and think you're king of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it. But it isn't going to do anything. It's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything, but you're hoping that the person then thinks that somebody else will buy something 5 years later from him. In other words, you're betting on not just how scared people are now of paper money, you're betting on how much they think a year from now people will be scared 2 years from then on.
Having seen that Warren Buffett is not a fan of gold as an investment either, let's move on to the next category of investments in our hierarchy. As investors, we not only want to keep up with inflation, but we want investments that can outperform inflation and produce a real return for us. This is where what Warren Buffett refers to as productive assets comes into the picture. We all know that Warren Buffett made his fortune by buying stocks and entire companies. Businesses can be regular or really good. The regular ones have a couple of characteristics, one of which is that these types of businesses require a ton of additional capital to keep operating, also known as capital intensive, with high capex. Unfortunately, most of these businesses will not do well in real terms during inflation. Your earnings may go up a good amount over time, but you are forced to put more and more dollars into the business just to stay in business. The worst kind of business is the one that makes you put more money on the table all the time and doesn't give you higher profits. An example of capital-intensive companies would be the automobile industry, which to produce new cars requires the purchase of materials and manufacturing that increase at the same rate as inflation. Another type of companies to avoid in periods of inflation are those without pricing power. The best way to explain what I mean by companies that do not have pricing power is to give an example, so let's go back to the previous example. Given that the automotive sector is highly competitive, it will be difficult to be able to raise the price as much as they would like if they do not have a distinctive feature that makes them unique, as is the case with luxury cars, since customers would then buy another brand. An even clearer example would be a company that manufactures white t-shirts, which, even if raw material and manufacturing costs rise, will not be able to set prices up since the customer will not hesitate to buy a cheaper alternative from the competition, since practically the only thing that matters to the customer is the price. An inflationary environment is going to be tough for this company. The cost of materials to make the shirts is going up, the cost of paying workers to make the shirts is going up, and the cost of shipping the shirts to customers is also going up, and the only thing that is not really going up is the price the company can charge for the shirts now. This is why inflation is so difficult for companies with no pricing power. By contrast, one company that does have great pricing power would be Apple. Apple has such a loyal customer base that many will pay whatever the company wants to charge for its product. If someone wants a new iPhone, they are not going to buy a competitor's product just because it is cheaper. They have an ecosystem and reputation that keeps customers from going to a competitor, so they have much more room to raise prices. With this example, let's move on to the next and better investment category. We are going to call it investment in productive assets, but in this case, quality business assets. Let's say an entrepreneur invests 100,000 euros in developing a program that in the first year generates 120,000, that is, 20,000 of profit, which is very good, but it becomes even better in the following years, since this type of business requires, in most cases, a very small investment and of course much less than the initial investment. These are considered capital-light companies, as the investment to maintain business operations is minimal. And that is exactly what Warren Buffett is referring to in the following video.
You've described inflation as a gigantic corporate tapeworm. Which of Berkshire's businesses are best suited to thrive during a period of high inflation, and why? Which will suffer the most, and why?
Yeah, well, the best businesses during inflation are usually the best. They're the businesses that you buy once and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation.
In addition, if the company so chooses, it can raise the price of the program to reduce or even nullify the effects of inflation. A company that is not capital intensive, has good pricing power, and is also at an attractive multiple is undoubtedly the best investment to make in inflationary times. With this, we say goodbye to the video. I hope it has been helpful. If you liked it, leave your like and subscribe, and don't forget to leave your questions and opinions in the comments.